Tesla's stock price is down over 40% year to date after multiple months of red flags about EV demand and some questionable company decisions. As a Tesla shareholder, it's tough to ignore this short term volatility and just focus on the long term. But with new price cuts, announced layoffs, and a strange Cybertruck recall, I think all of it is worth talking about. Let's get started. Over the weekend, Tesla reduced the price of their vehicles again. Not only in the US either, but multiple global markets, including China. Models 3, Y, X, and S were all cut by about $2,000. What's interesting is the price reductions aren't just affecting vehicle prices, but also the software Tesla offers its drivers. The infamous full self-driving package received a price cut from $12,000 to $8,000. If I remember correctly, Tesla began the EV price wars all the way back in 2022 to challenge the rise of competitors like BYD. And the price cuts were significant. Tesla took a huge hit to its margins. So why continue to lower prices? It seems like whatever stimulus the previous price cuts introduced has wore off completely. Tesla's global vehicle deliveries in Q1 fell year over year for the first time in several years. The expectation was that Tesla would deliver roughly 454,000 vehicles, but in actuality, only hit about 387,000. Is this the result of cheaper competition, a general cooldown in EV demand, or has Tesla's brand taken a hit due to Elon's controversies? It's hard to say for sure. I'm assuming a negative net effect of all three. But one thing is certain. Tesla expects the demand struggles to continue. That's why they're cutting prices. They're looking to re-stimulate demand in each of these markets at a time that multiple factors are making Teslas less attractive to consumers. If you recall from their 2023 annual report, their financials weren't the best. But what concerned investors the most was their anticipated slowdown in growth for their car business. We still have high interest rates. It looks like they will remain high in the near future, by the way. And these rates have made big ticket items like cars very expensive to finance. The average loan terms for a prime borrower is a 6.88% interest rate for 70 months. That's going to impact the demand for a Tesla. Another factor is, again, the competition. Is Tesla still king of EVs? For sure. But there's some players starting to knock on their door. And really, BYD is the main concern. They're crushing it in the Chinese market, which happens to be the world's largest EV market. They're making extremely affordable options, plus offering a long list of models, while making these same vertical integrations that Tesla used to dominate the space over the last decade. The bottom line is that every comparable competitor vehicle sold is a Tesla staying on the show floor. All of that said, I think the biggest long-term factor that's dragging down EV demand, across the board really, is the overall lack of EV infrastructure. There just aren't enough charging stations to accommodate today's EVs at their current ranges. According to a AAA survey, 60% of respondents cited charging station scarcity as a primary roadblock for not buying an EV. And very related to that concern, 58% cited range anxiety as a prevalent mental hurdle. This is also why, in my opinion, PHEVs, or plug-in hybrid electric vehicles, that's a mouthful, are catching the interest of those consumers that are on the fence. Again, going back to rising competition. You have to convince people that EVs are logistically viable. You can't have some glaring inconvenience that does prevent the utility of a Tesla from being fully realized. People are going to stick to gas-powered vehicles in that case. I can tell you right now, if there was just a bit more EV infrastructure around me, I would have purchased a Tesla a long time ago. In a memo to their employees, Tesla announced they're going to lay off 10% of their global workforce. That's the equivalent of about 14,000 positions. The reason? Leaner operations to support the next phase of growth? Interesting. Look, it's pretty clear these layoffs are more about the business contracting and less about increasing productivity, as stated in Elon's memo. Tesla has a huge earnings report coming up, and the company has to show shareholders that they're doing something to keep those financials up. And unfortunately, reducing headcount is one of the quickest ways to do so. Every business has a right to adapt their workforce to whatever situation the company is in. Business can be unpredictably dynamic. And if the cash Tesla frees up by cutting payroll goes to initiatives to re-stimulate growth, then I can see that being acceptable from a shareholder perspective, but I'm not so sure that's the case. Tesla is asking their shareholders to reconsider awarding Elon with a $56 billion pay package that was previously ruled to be a flawed deal. Whether you agree with the compensation or not, you have to admit the timing of it looks terrible. You decide to lay off 10% of the company, but then ask for a $56 billion payout? Assuming an average salary of $106K for a Tesla employee, the cost to retain 14,000 positions is about $1.5 billion. Now, that's a gross simplification of it, but you can see why the optics are so bad. And hey, I'm 1,000% for company owners receiving their fair share and being generously compensated. I'm all for Elon getting his pay package, but why right now? I can tell you this, $56 billion would go a long way in expanding their charging station network. Just saying. The Cybertruck got hit with a recall after it was discovered the accelerator pedal pad was at risk of coming off if enough force was applied. This poses a pretty significant safety risk, as showcased by a TikTok that claims the pedal pad detached, became stuck, and held the truck at full acceleration. The recall gives Cybertruck owners the option to rework or replace the accelerator pedal if necessary at a service station or by their mobile service team. There is, of course, no charge for the repair. This is obviously a big deal from a safety perspective, and I'm glad it got enough attention to warrant a recall, but the recall itself doesn't seem to be that detrimental to the company from a cost perspective. Some recalls could cost billions of dollars, which was the case for Toyota when they had to replace rusted truck frames. The real cost here is the hit to Tesla's brand as an auto manufacturer. I've said countless times in the past, Tesla's biggest competitive advantage is still their brand, and there's no quicker way to destroy a brand than quality issues. But the truth is, every automaker is going to run into these problems. It's inevitable. And really, the most important thing is how they respond, how they make it right with customers. That's why Toyota survived that multi-billion-dollar recall and is still synonymous with quality brands. I think Tesla is handling this right.
So before I could get the video out, Tesla did report their earnings and talk about a situation that is a constant reminder that when it comes to the short-term movements of stock, investors know nothing. And let me clarify, because it's not that they know nothing, it's that predicting the short-term movements of stock is just impossible. Overall revenue was down 9% year over year, came in at $21.3 billion. Net income is down 55% year over year. And automotive revenue, which in my opinion is the most important metric because it's their core business, I believe that was down 14%. I could be wrong. I was in fact wrong. It's 13%. And to keep this quick, basically, they already alluded to growth continuing to be slow throughout 2024. The same issues they were facing at the end of last year that was impacting their forecast still exist. They're going to affect volume, profit margins, and just the general outlook on the numbers that they can produce. So now that begs the question, if they missed on earnings and their expected growth is to be slow, why is the stock up? I mean, the stock absolutely exploded after hours and going into the next trading day. And really it has to do with the future prospects that the company is promising now. They did address that they are going to reverse their stance, whether it was true from the beginning or not, that Tesla is going to focus on cheaper models, more budget-friendly, economical models, including a long list of different models that they're going to be bringing to the showroom floors. Let's also not forget that the announced layoffs, laying off 10% of their workforce, probably had a positive impact on the stock price. Why is that? Well, because to shareholders, more layoffs, a leaner organization, that just means better financials, which is unfortunate. And of course, you can't discount the impact of the discussion about future technologies had on the stock price as well. They mentioned robotaxi, they mentioned AI, and they mentioned, which I think is important from a financial perspective, that both energy and their other sources of revenue, the different ways that they diversify their revenue streams, were all positive. Those aspects of the business look like they're going up. All very interesting stuff. That's the thing about tech, and the general thing about growth stocks is you never know which factors or what headlines or which KPIs are going to lead the stock to just absolutely explode. If you focus too much on the month-to-month or quarter-to-quarter movements of these stocks, your mind is going to be up and down and sideways and around, and you're just much more likely to make a mistake. That's why I focus on a multi-year time horizon. But anyways, let's get back to the outro and send you on your way.
All right, y'all, let's end this one here. Tesla's had a rough start to the year, down over 40% year to date, heading into a Q1 earnings report with tons of concerns and tons of questions. But my opinion hasn't changed as a long-term Tesla shareholder. I'm bullish on the distant future. The near future, not so much. As always, thanks for watching. Until next time, take care of yourself, and best of luck.